Hi, and welcome back to the financial plan. In our previous video, we started talking about business assurance and doing a business needs analysis on a company as opposed to an individual. And we started out by talking about partnership insurance, where the shareholders in a company would insure each other's lives and then have buy and sell agreements drawn up to ensure that there was continuity should one of the parties die or become disabled. And today we're going to move on to talking about key person assurance. Okay, so Dylan, maybe you can explain a little bit, or what, in a nutshell, what is key person assurance?
So, Jay, key person assurance is where a key individual of the company, would become disabled or pass away, and the company would financially suffer if that were to happen, and they were no longer able to, operate as an effective part of the company and perform their functions.
Okay. So in what way, Jean-Luc, would you say the company would then suffer financially? There's a couple of different ways.
Yeah, so if someone is a key individual for the company, that means there would be significant loss if they weren't around. So that would be the best salesperson in the company, or a master chef at a restaurant. And that's what will create that insurable interest, as there will be a hole left should something happen to them and they're not
productivity goes down, the company they make less money.
100%, yeah.
Okay, so the payout would then obviously help the fact that productivity and less money coming into the company.
Yeah, exactly. So it'll provide them sufficient capital to be able to not only plug the gap in terms of the loss in productivity over the time, but also help them recruit another individual of a similar qualification or standing to fulfill the same sort of role, which can be quite an expensive process.
Okay, so you could actually headhunt somebody by saying, we've got a lot of money here to be able to do that, we'll match your salary, but here's a nice suite, and headhunt somebody to get that continuity.
Yeah, exactly.
Yeah.
Okay, all right, cool. So in terms of insurable interest, you mentioned that word earlier. Just expand on that a bit.
So this is where there is a reason to take out the cover. That is where now you have your insurable interest, as there will be a financial loss should something happen to them. So that is the reason to be able to take out the cover, is the financial loss, which also applies on individual policies, individual cover that someone may take out.
Okay, that makes sense.
So it's stressing financial implications.
Exactly, yes.
Okay, and Dylan, how would a key person policy be set up? How would it be structured?
So basically what would happen is the company would own the policy. They would take out the policy on the key person, the key individual, so that would be the life assured. The company would then own the policy, be the payer, and they would also be the beneficiary. So they would receive the interest that comes from that, the payout that would come from the
actually go to the company. Okay. So this differs now in terms of what we spoke about last time, where the company is really not involved at all. It's a purely, the buy and sell agreement is purely between the shareholders, making sure that they can keep control of the company if somebody passes away or becomes disabled. Here the company is actually the owner, the company is the beneficiary, and the directors of the company can make those calls as to what to do with the money, correct?
Yes.
Can the shareholders be key person as well? So could you have, you have to do partnership insurance and keep with the same people?
Certainly, but again, they would have to be key contributors to the company. So they would have to play an important operational role within the company itself. So you could have, a dual partnership, but if one of the partners is more of a silent partner, they don't really come to work, they just kind of get their shares from it, that wouldn't be a key contributor, so therefore there would be no insurable interest for key person in that aspect.
No, okay. Well, the company wouldn't necessarily suffer financially if they died. You just need to make sure that you had money to buy out the shares.
As we spoke about last week,
Cool. And typically, what would be the amount of cover that a company should consider taking out on a key person?
Typically, it's an application anywhere between 7 or 8 times that key person's annual salary.
Okay. And are the contributions tax deductible?
No, not in this case. In accordance with Section 11W, you cannot allocate that as a tax deduction for the company.
Okay. And in the past, this was an option where you could the key person could be structured as what was called a conforming or non-conforming policy, where the company would have the option of claiming the contributions as a tax deduction or not. Problem was, if they did claim it as a contribution, then the payout would be taxed at 28%. And if you've got a good couple of million getting taxed at 28%, so now that it's not an option and it's not an expense, it's not really an issue, because the full 7 times would be paid out, as opposed to getting taxed as well.
Yeah.
Okay, so Jean-Luc, would you like to wrap up for us?
Okay, perfect. So in terms of business assurance, we've covered 2 areas so far, that being partnership insurance as well as key person insurance. When we come back next week, we will be discussing preferred compensation. Thanks so much for tuning in, and we'll see you next week. Please don't forget to like and subscribe.